What if somebody placed an investment menu in front of you offering a potential 10, 12, or even 15% annualized coupon? Would you immediately say, I'll take one? Well, not so fast. Because on Wall Street, the largest number printed on the menu may not be the most important ingredient in the recipe. That attractive coupon, it could come with some conditions. That downside protection could disappear. That investment could be called away early. And that supposedly diversified basket could be controlled by the single worst performing investment inside it. Today, we're putting structured notes on the menu and we're breaking down the entire recipe. The potential income, the underlying investment, the buffers and barriers, the call provisions, the issuer's credit, the liquidity limitations, and the hidden heat that could put your principal on the chopping block. Because before you order the coupon, you need to understand what you're being paid to risk. Welcome everybody to the Unbearably Bullish podcast. This is the official podcast of the Bull You Can't Bear. I am your host, Donald Johns, and welcome to Taco Tuesday, where we take complicated financial concepts, put them on the plate, and serve them in a way people can actually understand. Today's special, structured notes on the menu, big coupons, built-in barriers, and hidden heat. So let's build the taco. Every taco, it needs a shell, and every investment discussion, it needs a foundation. A structured note is generally an unsecured debt obligation issued by a financial institution. But unlike a traditional bond with a relatively straightforward interest rate, the return on a structured note is connected to the performance of an underlying reference asset. That underlying asset might be a single stock, an equity index, a basket of stocks, an interest rate, a commodity, a currency, or several investments combined into one structure. The recipe normally contains two major ingredients, a bond component and an embedded derivative. The bond component represents the issuer's obligation to make payments according to the note's terms. The derivative component creates the formula connecting your potential return and possibly your principal to the underlying investment. Here is the first critical distinction. When you purchase a structured note linked to a stock, index, or basket, you generally do not own those underlying investments. You own a security containing a contractual payoff formula. You are not simply investing in what the market does. You are investing in a contract describing what happens if the market does certain things and in the issuer's ability to honor that contract. That brings us to our first bull bite. A structured note is not merely an investment in the market, it is an investment in a set of conditions. Now, let's add the meat. Structured notes can be designed around different investment objectives. Some people seek to produce contingent income, some offer conditional downside protection, some provide enhanced participation in potential market gains, others combine income with exposure to a stock, index, or basket. That customization can be attractive, but customization does not eliminate risk, it rearranges it. If a note offers an unusually large potential coupon, the right response is not simply, that looks delicious. The right question is, what risk am I being paid to accept? Maybe your upside is capped. Maybe the income is conditional. Maybe the note can be redeemed early. Maybe your principal is exposed if a barrier is breached. Maybe you cannot easily sell the note before maturity. Or maybe your outcome is determined by the worst performing stock in an entire basket. Wall Street does not add extra yield to the plate for free. Somewhere in that recipe is a trade-off. Your job is to find it. Now, let's examine some of the toppings. First, we have contingent coupons. A note might advertise a potential annualized coupon, but payment may depend on the underlying asset remaining at or above a specified coupon barrier on each observation date. If that condition is not satisfied, the coupon may not be paid. Some structures have a memory feature that may allow previously missed coupons to be paid later if specified conditions are satisfied. Others do not. The word coupon alone does not tell you whether the payment is fixed, conditional, or recoverable. Next, we have auto-callable notes. An auto-callable note may be redeemed before maturity when its underlying asset satisfies a predetermined call condition on an observation date. That might sound harmless. You receive your principal and any payment required under the terms, but now the attractive income stream has ended. You must reinvest the money, and the same opportunity may no longer be available. The note may remain outstanding when the underlying investment is struggling, but disappear early when conditions are favorable. The kitchen can take the plate away just when you are beginning to enjoy the meal. Next are the buffers. A buffer may absorb a predetermined portion of a decline. Imagine a note with a 10% downside buffer. If the underlying investment declines by 7%, the buffer may absorb that decline. But if the underlying falls by 30%, the investor could lose 20% depending on the precise terms. The buffer absorbs the first defined portion of the loss. It does not necessarily create a maximum loss. Then we have barriers. A barrier may provide conditional protection only while a predetermined threshold or observation condition remains satisfied. If the barrier is breached, some or all of that protection may disappear and principal could become exposed to the underlying asset's decline. This distinction matters. A 30% barrier does not automatically mean the investor can lose only 30%. It could mean that protection remains available only while the underlying does not decline beyond that level, subject to how and when the barrier is measured. There are also participation notes, which may provide exposure to a percentage of an underlying asset's appreciation, but the return could be capped. The market might rise 30% while the note's maximum gain is limited to 12%. Finally, there are notes marketed with principal protection features, but principal protection does not automatically mean risk-free, liquid, or government guaranteed. Any promised repayment remains subject to the note's precise terms and the issuer's ability to pay. Let's create a completely hypothetical note strictly for educational purposes only. We'll call it the Bullish Barrier Taco. Here is our fictional recipe. A $100,000 investment, a 2-year maturity, a potential 12% annualized coupon observed and potentially paid quarterly, 3 hypothetical underlying stocks, a coupon barrier set at 70% of each stock initial value, a principal barrier set at 60%, quarterly call observations beginning after 6 months, and one especially important ingredient. It is a worst of structure. That means the worst performing stock, not the average performance of the basket, may control the outcome. Let's test 4 possible scenarios. Scenario 1, the market cooperates. All 3 stocks remain above the coupon barrier. The quarterly coupons are paid. After 6 months, all 3 stocks satisfy the hypothetical call condition and the note is automatically redeemed. The investor receives the principal and the 2 quarterly coupons required under our fictional terms. That could be a successful outcome, but the note lasted only 6 months, not 2 years. The investor cannot assume that the advertised annualized coupon will continue for the entire original term. Let's go to scenario 2. 2 stocks rise, but the third falls below 70% of its starting value on an observation date. Because this is the worst of note that single stock controls, the coupon decision under our hypothetical no memory structure, the coupon for that quarter is not paid. 2 winners do not rescue the plate. You ordered a basket, but the weakest ingredient determined the meal. Let's go to scenario 3. At maturity, the worst performing stock is down 45%. It finishes at 55% of its original value, below the hypothetical 60% principal barrier. Under our fictional formula, the conditional protection disappears and the investor participates in that 45% decline. The $100,000 principal investment could return only $55,000 plus any coupons that were actually earned and paid. A potential 12% annualized coupon did not eliminate the possibility of a much larger principal loss. That is the hidden heat. Scenario 4, the issuer fails. Suppose the underlying stocks perform well, but the financial institution issuing the note cannot meet its obligations. A structured note is generally an unsecured obligation of its issuer. If the issuer defaults, the investor could lose scheduled payments and principal regardless of how well the underlying assets performed. There are two scoreboards: what happened to the underlying investment and whether the issuer can fulfill its promise. Let's add the guacamole, baby, but remember, guacamole, it costs a little extra. Structured notes may provide customized market exposure, potential contingent income, defined payoff conditions, conditional downside buffers or barriers, and access to strategies that might be difficult for an investor to reproduce independently. In an appropriate situation, a carefully evaluated structured note may serve a specific role within a diversified portfolio. But complexity is not automatically sophistication, and a large coupon is not automatically value. The product must fit the investor, not merely attract the investor. Now bring out the hot sauce, baby. Market risk. The underlying investment can decline, potentially causing a significant principal loss. Issuer credit risk. Every promised payment depends on the issuer's ability to meet its obligations. Complexity risk. Small differences in barriers, buffers, observation dates, and payoff formulas can create dramatically different results. Liquidity risk. There may be a limited secondary market. Selling before maturity could be difficult or require accepting a substantial discount. Call and reinvestment risk. The note may be redeemed early, ending the potential income stream. Concentration risk. Too much exposure to one issuer, one product type, or correlated underlying assets can magnify losses. Valuation risk. The issuer's estimated value at issuance may be lower than the price paid because the offering price may incorporate selling, structuring, and hedging costs. Opportunity and cost risk. The underlying investment might rise significantly while the note's return remains capped. And tax risk. Structured note taxation can be complicated and may vary by product, making professional tax guidance important. Let's do the bull versus the bear, myth or reality. The bear says a 12% coupon means I will earn 12%. Not necessarily. The coupon may be contingent, the note may be called early, and some payments may never occur. The bear says a 30% barrier means I can only lose 30%. Wrong again. The barrier may identify the level at which conditional protection disappears, not the maximum possible loss. The bear says 3 underlying stocks, it means I'm diversified. Well, not necessarily. In a worst of structure, one poorly performing stock may control the entire outcome. And finally, principal protected means guaranteed. No, any protection is governed by the offering terms and depends upon the issuer's credit worthiness. Do not order from the headline. Read the entire recipe. Here's today's Taco Tuesday challenge. Before evaluating any structured note, identify these 10 ingredients. Who issued it? What is the underlying asset? Is it linked to one asset, a basket, or the worst performer? Is the coupon fixed or contingent? What is the coupon barrier? What protects the principal and under what conditions? How and when are the barriers observed? Can the note be called early? Is there a realistic secondary market? And what is the maximum possible loss? Here is the challenge. If you cannot explain the payoff on a napkin, you are not ready to order it. Let's do the taco takeaway. Structured notes can provide customized exposure, contingent income, and defined protection features, but the headline coupon tells only one part of the story. You must understand the issuer, underlying asset, payoff formula, barriers, buffers, observation dates, call provisions, liquidity, limitations, and maximum potential loss. We're going to do my Bull's bottom line here. Never confuse a designed outcome with a guaranteed outcome. Structured notes are built with conditions, trade-offs, and counterparty risk. Read every ingredient, stress test the downside, understand what could interrupt the income, know what could expose your principal, and determine whether the product fits the entire portfolio, not merely your appetite for a large coupon. A disciplined investor does not ask only, how much could I make? A disciplined investor also asks, what has to happen for me to earn it? And what could happen if I'm wrong? That is today's Bull's bottom line. I want to thank you for joining me again for another Taco Tuesday on the Unbearably Bullish podcast. Always remember, we focus on strong markets, stronger mindset, unlimited opportunity, always follow the herd, and always remember to stay unbearably bullish. I'm your host, Donald Johns. I love all of you. And until the next time, have a successful, productive, and a profitable day. Going to do the disclosure. The opinions expressed in this podcast are those of the host and are provided for educational and informational purposes only. Nothing presented constitutes investment, legal, or tax advice, and an offer to sell or solicitation to purchase any security or investment product. Structured notes are complex securities that may involve market risk, issuer credit risk, liquidity risk, call risk, tax considerations, and the possible loss of principal. Features, terminology, payment formulas, and risk vary substantially among offerings. Any hypothetical investment, coupon, barrier, return, or outcome discussed in this episode is illustrative only and does not represent an actual offering, recommendation, or guaranteed result. Investors should carefully review all applicable offering documents and consult appropriate financial, legal, and tax professionals regarding their individual objectives and circumstances. Investing involves risk, including the possible loss of principal. Past performance does not guarantee any future results. Friends, have a wonderful day.